John. My job is to teach you guys the strategies and the rules, and also to show you different ways to use different indicators. So as I always like to say, if you have any friends that you'd like to bring, please send us an email. You can all send me an email if you like, and I'll send you a replay link of one of our previous presentations. We've done hundreds of them, and they're pretty much all the same. So just send it to me at melaniesuntrades@gmail.com. That's SON, like the Chinese sun, even though I'm not Chinese. And this way, you can, I'll send you the replay. So if you have friends that you want to watch one of our intro presentations, we will send you that link, and then you can always have them call, and I'm happy to talk to them and answer their questions so they can have a better educated decision. All right, so let's get going. So I'm not going to waste any more time. I'm going to be talking about, obviously, the strategies that shadow traders is designed. Now, if you're a new person, you have some homework. First thing you want to do is you want to go and watch all the videos that say clear trade and all the videos that say gap trade. And then there's one more strategy called reversals. You want to watch a video that talks about reversals versus retracements. Now let me just do one real quick thing here. I'm just going to pull up the Shadow Traders website because I do want to show you something really quickly. Now, if you go to the Shadow Traders website and you go into the members download section, there are some extra PDFs for you to revise. And one of the documents which gives you the rules for the two basic strategies, which is our clear trade and our gap trade, which is really a trend trade and a counter trend trade, is all listed in this 10-second document. So you want to load up this 10-second document, and I've just created really a short list of these rules. These are the rules for the basic strategy. Now, we do have videos for that, and also if you go to the self-paced section, very important that you read through section 7, which covers indicators, and section 5, which helps you to put it all together. Let me just do this. So if you go to the self-paced course and you sign in over there, most importantly, I'd like you to read through, when you start to go through the FAQ section, click on the answers for support. You'll see a bunch of videos of getting started and all the basics just to help you get started. But also in instructional and live trading, there are videos like here, clear trade, learn to recognize a clear trade. You must, this is also important, setting up the dome, using the dome. These are your basic instructional videos that cover a lot of the newbie questions. Now, section 7, when every time we release software, remember we're shadow traders, all indicators are free for life. So anytime we release a new indicator, like the latest one I think was the HMA color change, then you will go to section 7, and you can see there's 81 sections here, and we cover all the different indicators in here that you can choose from. Now, I'm not always going to be talking about all these indicators. Your job is to go and start with a basic template, and I recommend my Mel Basic template in getting started. So the Mel Basic template, the Mel Basic chart, gives you the core charting without all the extra bells and whistles. And remember, with indicators, they work some of the time, not all of the time. So no indicator is 100% by itself. The key thing is here, you want to pick a few of your favorite ones that help you to see your strategy, your favorite strategy more clearly. So start with that, and then you can add things like the HMA, color change, and so forth. You don't need to mess with the parameters. The parameters are all set for you. I get a lot of questions about what's on calculate and bar close, true and false. Don't make it complicated. Just load a template, and then you can make changes. The parameters are all set for you. So there's no need to get all confused and yourself in a tither. Example here. Let's this is an okay example. Okay, so here basically what we're looking at is our trend trade in the candles are moving away from the moving averages and going with the majority of the moving averages. We use the moving averages to define and to visualize the actual trend direction, whether it's bullish or bearish. Now, our basic counter trend strategy is when we're going doing little short bounces of things like pivots or fractals and going into the moving averages, trying to change the direction from the previous bearish to bullish. Now, what you'll find with retracements or counter trends, we call them gap trades essentially, is that we get two types. We get one that's called a retracement, that's very short-lived, and the trend then continues following the retracement, and the other one's called a reversal. Reversals actually are more successful in changing the direction of the previous trend direction. So usually reversals occur when the trend is petered out, the previous trend. Now, to help to see the reversals, essentially, what we look for is the correlation of the MACD and the STOs. When the STOs and the MACD are in sync with your 13 and 20 cross pretty much, they all line up as this nice sequence. And what we're really looking for as well, in addition to that, is that the MACD is below or above the center line. So here you see the zero line, or the center line as some of us call it. When you see the MACD is now below and the STOs are at the bottom, we have clearly seen that the market has heavily sold off and we are oversold as a condition in the market. Once we reach that state, the market will start to then recoup and go back to overbought. And this alignment is what we call the perfect trade. Really, it's a reversal trade. The reason why we call it perfect trade, because essentially it's the perfect time to do your counter trade or gap trade strategy. You'll get a little bit more out of it than you would a simple retracement, and a lot better chance of consistency. Can you go over what is needed to look for in a clear trade in Segreta charts? I'm not going to do Segreta today. I'll do Segreta next week. I touched a little bit on it last week because I wanted some replay today, and I wanted to show you the rules for entry on the technicals. Now, Segreta is very simple because it's going to give you the same principle, number one, number two. And that's really all it is. On the same rules of entry, you're going to go look for those number ones and twos that show up. And when you see them concur with the indicators, then you will have more confidence to take the trade. So let's just get started here. So essentially we're looking for a trend trade that goes with the moving averages, and we're looking for a counter trend trade. One is a reversal and one is a retracement. The retracement type trades we always keep to 3 ticks. That is our basic scalping trade. And the reversal we can go for a little more. We trade till the next barrier, usually the 50 moving average most of the time. So I've shown a few futures trades here from yesterday's market, because really what I want to talk about a little bit more today is also the alignment of the higher time frames. I want to talk a little bit about the algorithm and how you should be recognizing these self-organizing patterns and their relationships with the higher time frames. And also for those people who want to be true trend traders as opposed to scalpers, you can go for more ticks looking at the higher time frame. So let's look at this trade here. We're gonna start here at 8:25, 8:26 in the morning. That's generally when most people start trading. And I want to focus on the basic rules. So right now we're presented with a situation where we're looking for a trend opportunity. Now, what's the first thing I look for when I look for a trend opportunity? The first thing I look for is the position of the moving averages. With trending, I don't always look at the MACD and the stows. You're going to see that at this particular moment they're out of sync. You can see that this looks like it's trying to come down. The stows are coming down here on the 3-minute chart. These are pointing up, and it's above the zero line. So how high it's going to go to overbought section, who knows? But what I am looking for, remember in the last couple of classes I talked about the pivots, and I also referenced the where the market likes to go. Now, whenever you're faced with something like this, the R3, and you're looking for, whenever you're faced with the R3 and you're looking to see how close that 13 is coming to the R3, remember, what is the R3? The R3 is a wooden floor, and the other pivot, the red pivot, the PP, is a concrete floor. So notice that the market came down and hit the red pivot, which is a concrete floor, along with the 200, and never penetrated. It never cleared south of the border. So what do we know? That this support was really strong and the market held to that support. So now I'm looking at the direction and saying, wow, if they never penetrated support, chances are they could cross that R3 because it's a wooden floor. All they need is momentum with wooden floors, and the majority of the trend lines supporting the direction, they'll plow right through that thing like a hot knife through butter. As you can see here, it didn't even hiccup on the previous move. Now, additionally, if I notice on the next higher time frame, which is my 3-minute chart, I see that also they have the 50 and the 100 right there, additionally as support. So really have a strong support point pointing in the direction of the uptrend.
All you're missing is a psychiatrist.
A support system. Yeah, is that what I didn't say? She gave him the.
Can you show the alignment correlation of the trend and gap close with Segredo findings? I can't do the Segredo right now, guys. I know that's what we have for Wednesday nights for, yeah? But I will, like I said, I'll cover the Segredo next week because I only have 2 hours with you and there's a lot of ground to cover. I can barely get it all in. And if I try to cover too much ground, you miss half of it anyway because you can only process so much information. So it's better that we break it up into sections, and this way you can really process it and assimilate it, and own it, and go duplicate it. That's the key thing here. Then we come next week, we'll cover it in a new way. I'll incorporate the Segredo for you, and we'll do that as the next step. So let's just go ahead and place a trade here because we're going to do this real time, and then we're going to talk through the rules, and I'm going to explain to you what it is I'm looking for. Now, the first thing I look for is how many moving averages are back in the direction. As you can see here, your 13 is above the 50, above the 100, above the 200. That's a good scenario. And they were in a fist. They were kind of consolidated. So what comes after a fist is usually a fan. Now, if you really want paying attention, if you go to a higher time frame, like a 5-minute, the higher time frame also helps you to see that indeed the trend is going up. So if we look here at the higher time frame, we look at things like the HMA is green. My Linregs are going the same direction. My 13 is taken on strong degrees. It's at 32 degrees. We're crossing. It's crossing its PP right there. We've got the support of the moving averages. So now when I look at this scenario, I've got the candle pushing through the HMA here. Notice that the thread candle is above the HMA. That's essentially what I'm looking for. And if I wait one more bar, let's go ahead and push play here. you'll probably see that the next candle will come in and the HMA will change color. Now you can see that my 3 minute has changed to green and the candle is above the HMA. So all I need is a green candle here and I am good to go just with this scenario. So I could use just a 1 and a 5 minute. I could use just a 1 and a 3, or I could use a 5, 3 and 1. What is the time showing on the chart? This is 8:25 in the morning. Now, 8:25 in the morning. So my 3 minute is green. My HMA is turned green and my candles are above. Now I'm waiting for a green candle here. 13 hasn't quite crossed yet. Ideally, I'd like that 13 moving average to be a little closer to that 20 SMA here on the 1 minute chart. But I do notice my MACD is crossing. So I'm going to wait here to see when green candles come in and my 3 minute goes green and I'm looking for this candle to push through. Then I'll have myself a trend. Here comes the green candle. Looking for momentum here. Here it comes. Looks like the 13 is more ready to cross here. My HMA is still green on my 3 minute chart. There's my 5 minute chart. So now I'm going to go ahead and place an order for 2 contracts. Just going to give you a different ways to trade your basic strategy. Now notice that we got a nice touching candle right at the cross of the 13 and 20. HMAs are looking really, really good. And I'm going to put 2 contracts on. My first contract, I'm going to exit at just a basic 3 ticks, just to see if I can get my basic scalping criteria filled. And then I'm going to leave the second contract. I could put it at 6 ticks or 7 ticks if I like it. And then I get 10 ticks out of one trade. Or I could leave this for a little longer and see how much I can get out of this trend. Now, why would I be essentially leaving it a little longer? Because what I'm looking at, let's just pause this for a second here. Notice I'm not suffering a whole lot of heat here. Okay, it might be dilly-dallying because it is summer doldrums and NG, doesn't move aggressively all the time. Kind of tinkers along and then moves in spurts. But really what I'm looking at is the fact that, let's look at our rules. So we entered on a touching candle or the very next bar. Now this happens to be touching at the cross. I like these candles that are touching right at that cross. I call them the Mac Daddy candle. Or the very next bar is okay too. But notice how close I am to the cross. This is the best time to get in on your trend trades. The further away you are from that 13 and 20 cross, the more whipsaw you're going to experience. So if you're a novice trader or nervous hesitant trader, you want to enter as close to these 1320 crosses as possible, looking for those turning candles, and you will experience a lot less whipsaw. Okay, so that's the first thing I always look for, because that tells me it's the beginning of a mini trend inside of a bigger trend. Sorry, my dogs are unruly today. So we're always looking to trade between the 13 and 20 crosses. So if I was trading from here, I'd be trading my trend trade, bouncing off the 13, starting with the first cross in the bullish direction. The next thing I'm looking for, 13 moving average must be 15 degrees or more trajectory. So if you look at the little degrees box here, you see that it's at 30 degrees. That's really good. Anything above 15. Now you can also further qualify which ones you're going to take. Like some traders say, well, I'm not going to enter unless it's 25 degrees or more. Some traders say 75 degrees. So you can further qualify which self-organizing trends you're going to take using the degree factor. Do you need the touching candle only on the 1 minute chart? Yes, only on the 1 minute chart, guys. That's your That's your focused timing of entry. The fact that the rest of the I'll come to the other time frames in just a second. Let me just finish this next step here. And obviously, we need the three moving averages back in the direction of the 13 EMA. So here the 13 EMA is crossing that 20. Notice that it hasn't changed to light green. I don't always need it to change color to qualify, because sometimes it's on the money, sometimes the color changes a little laggy. As you can see here, it was light green and then changed to dark green a little later. So I don't always use that, especially in lightly traded markets like right now. In a regular market, you can use something like that as a filter when you know that you're in longer term trends. So I don't always use the color change qualifier. But I do look for the cross. It must really look like it's ready to cross, and I try to catch that candle or the very next bar. I don't really care how far this bar is away from the 13, just as long as the next bar follows the touching candle on the 13 EMA. That's the important factor here. If you're 3 bars in or 4 bars in away from the touching candle, then know that you're going to experience some whipsaw. A lot of people miss this point. I can't tell you how many people still go, yeah, I was doing a trade, but yeah, you entered on the 4th candle. It's time for a pullback at that point. It must be the touching candle or the very next bar, not candle number 3, candle number 4. And this is where Segredo is really going to help you as well, because Segredo is going to give you a number 1 or 2. It's actually going to get you in somewhere over here. Number 1 or 2 or number 3. Vicky says, are you talking to me? Yes, Vicky. She's the queen of getting in on candle number 3 and 4. So the R3 does not bother you. No, that's the beautiful thing about wooden floors. Remember last week we talked about wooden floors. There's only 3 major concrete floors. That is the PP, the S3, and the S4, right? Now, the beautiful thing about going long is there's so much agreement to go up, right? There's only 2 conditions that drive the market, okay? Fear and greed, essentially. But fear will drive the market harder and faster than greed. But when things start to move up, there's a lot of agreement to continue higher, and it'll move in stair steps. And know this, when it comes to these pivots, what the R3 is telling you, if we're going to cross that R3, the probability factor of running to the R4 is very strong, especially if you have this additional thing. If you have 2 or more time frames in sync with that direction, meaning they're also green and they also show the majority of the moving averages back in the direction, you have yourself what I call matchy-matchy across the board. So let's take a look at that to help you recognize this criteria. So if we look at here, we see on 3 minutes, do we have majority moving averages back in the direction? Remember, the higher time frames, we only use 4 moving averages. We don't use the 200. We only use the 200 on the 1 minute chart. So here we have all 4. And our HMA is green. Our Linregs are nice and vertical, they're cross parallel. My goodness, how could we ask for more in terms of a trend? It's not even going to be bothered by that R3. Look how many times it just pushes through the R3. Doesn't even see it. We look at our 5-minute chart. Look at our 5-minute chart. It's pushing through our HMA. That's what we want. We've got nice momentum. The fact that we have momentum in these bars tells you we're going to cut through this wooden floor like a hot knife through butter. And now if I add the one more ingredient, which is essentially what I want to highlight in today's class, is the higher time frame. If we look at something like a 15-minute, now you can trade with just a 15, 3, and 1 very nicely as well, or you can trade it with a 15, 5, and 1. Or you can look for just these touching candles alignment with the 15. You can trade with just 2 charts if you like, and a Segredo. Let the Segredo tell you the number 1 or 2. There's your touching candle with the majority moving averages. And if you look at our 15-minute chart, what do you see? 15-minute is green. We've got majority of the moving averages. Notice the 13 is crossing here. Okay, and we have our MACD going through the center line. Now, let's look at a couple more things. Let's do something really interesting at the moment. Let's go a little higher. We can do things like we can go to a 30-minute or a 60-minute, but I like to double my 60-minute. And now you can't do this on the actual Ninja short list here. You actually have to type it by putting your cursor on the chart and hitting your number keypad on your keyboard, 120. I like to go up in time to a 120-minute chart or a 240 chart. These are nice time frames to use because they're not a daily chart. A daily chart is a summary of everything. It's not easy to read a daily chart. It's just going to show you the extremes. If you want to go inside the daily chart and look at things a little bit more closely hour by hour, what do you see here? So two time frames to really notice that you can to watch for is the 120 and the 240. Sometimes if you're confused on the 120, you go higher to the 240. And I always say, if you're not sure about your technical alignment, always go up in time and keep going until things start to be more crystal. So here you can see, what does this look like? Well, you can see the MACD is clearly on the oversold section, and we're going a little higher here. Notice how close the R4 is in relation to the 120 touching candle. Whenever you see that pivot is so close in range, the probability factor of us running to that R4 is very high. Let me see if I can find a scenario. Here it is again. Here's a touching candle doing a reversal. There's the R4. Very, very high when you see the start of something. And here's another scenario. Here's the reversal. There's the R4. We plowed this again, oversold section going to overboard. It's the start of a move. It's like the start of the 200-meter sprint at the Olympics. So here you're faced with the higher time frame telling you where we are in the overall algorithm of the moving average trend lines. That algorithm is going to tell you your bullish and bearish information you're looking for. Now, it's not going to show you the little ups and downs for scalping viewpoint, but it's going to show you where we're likely to go. Here's another day, 712. Again, we're faced with a reversal on the 120-minute chart. Bang, hit the R4, came straight back down. Notice we came back down because the 13 didn't quite get there, but the price action made it. And we made it between 10 o'clock and 2 o'clock. Didn't take all day to do it either. There's another scenario, 6 o'clock, again, straight up to the R4. So watch for the ranges between the R4 and the S4, and look at the higher time frames to tell you where we are, and are we likely to hit those targets. That's it. Those 4 parameters make a clear trade? Yes, well, this is the short. I showed you the 10-second document, breaks it down even further, including some other indicators for you. But this is the short list. This is the summary. This is all we're looking for, guys. Touching candle, degrees on, must be trajectory in your 13 EMA. Majority of the moving average is back in your direction, and 2 or more time frames in sync. That's your trend. That's all you need to look for. And ideally, you want to get in as close to, as I'm demonstrating here, to the 13. But I'm showing you, let's take a look at, here's our 120. Let's take a look at what a 240 looks like. I just wanted you to see how it connects together. Notice here on our 240, we can always predict that for right now, this morning, going to be up trading, because what are we doing? We're closing the gap. You see, at the end of the day, no matter what time frame you're looking at, we're doing one of 2 things. We're either trending or we're closing the gap. And the gap we're referring to is it's got to go back at the very least, hit that 13, and if it's the end of a trend, it will continue in reverse. So if you look at something like a 240-minute chart and you see that its HMA has changed color, you know what a gap trade is. You know where it has to get to. It has to get to the 13. And incidentally, that 13 happens to be sitting at the R4. These are clues. You need to look for them. So you're looking for the probability. Now you can't see every whipsaw inside this candle, but you know this is ultimately where the market makers are taking the market. They want to hit these benchmarks. These are benchmarks they have to hit. Okay? That's what the algorithm of the market is. These are benchmarks. And understanding your trend versus gap criteria tells you in the shorter time frame what's going on. So you know that from this point of the HMA, look at the Lin regs, this falls into your gap trade criteria. You know that where this benchmark is likely to go to. See, this is all clues to tell you what's the future on your 1-minute chart, giving you an element of predict. Because we don't truly have any leading indicators for you, because price action has to form in order for indicators to populate. But we do give you an element of predict, and the best way to look for trending information is to look at the higher time frames. Now let's get a little more adventurous and go a little higher for a second. I really want to demonstrate this point. What I like to do is just double the times. 240 go to 480. Can you see the 480's HMA is also green? The Lin regs are above, and it's also looking like it's getting ready to close the gap. Look at the position of the R4 in relation to where the gap is. Now, this could take all night, all day and all night to finally gap close. But at least I know from the point of the HMA color change, with the position of my Lin regs, I know what criteria, what strategy is in motion based on this information. And the last time frame I look at every now and again, just to really confirm things, is I double the time, and this is my daily chart view, which is my 960. You can't go higher than a 990. You're really looking at a daily information. Okay, in terms of how the moving averages plot and from an algorithmic point of view. So 960 is really the highest you can go. But if you look at our 960 all the way up the time frame, you see that our 960, the price action has crossed the HMA. So now we know that the downtrend is officially over. And we crossed the HMA, we're north of the HMA. Our stows are at the bottom, so we're definitely overbought. Oversold. And it's green. So chances of us going up there, going straight to that R4 is very, very strong. So let's see what happens and how this develops. Everybody following me so far. Does anybody have any questions on this? If you have a green HMA on a higher time frame, i.e. 120 or 240, would you just look for longs on the shorter time frames? I wouldn't say I would just look for longs, but what I will tell you is that your longs are going to give you more price action. You are going to get some downs because the market has to buy and sell throughout the day. That's the rule of trading. It can't just buy. So it has to buy and sell. It has to fill both sides pretty much evenly. So you're going to get some downs and you're going to get some highs. But the longs are going to give you more price action. So when I see that kind of scenario, when I see that all the way up the time track, starting with the 5, the 15, going to the 120, the 244, I see we're green and we're clearly, what am I looking for? I'm looking to see which criteria is in motion. Is it my trend? See, on this day, on the 26th, I would have been looking at a downtrend for my bigger moves. Because this is my trend criteria. There's the touching candle, 13 EMA, majority of the moving averages, okay? But on this day, I'm looking for gap trade. And I know where the goal post is. Goal post is always to the 13. The fact that we haven't hit it yet tells me that we're going to have strong agreement to go long. Very good explanation, details, concepts. Excellent. Good to put them together. What side of the HMA is north or south? Whatever side the candle is. So here's the line. And if this candle is on the up side of it, well, north is up. And if the candle's on the down side of it, down is south. North or south. However you want to view it. But very big clue to help you with your trading. Especially in an area like this where you're not quite sure, it's just starting to develop on the 1 minute chart. I look at other time frames to see if it's more crystal. And the 3 minute already being north of the HMA here tells me I don't need to be concerned about this candle penetrating the HMA still. Look, this candle's already going through. I don't need to worry about that because this has told me we're already set in motion in the right direction. Should we always include the LINREG? You don't have to use the LINREGs. You can use just the HMA, and I will highlight how you can simplify things in just a bit. You can just use what you would like to use. I kind of have a little bit of everything here for different types of traders in the room. Excellent. Your higher time frame explanation was very helpful. Excellent. Okay, good. So let's actually execute this now that you can see what I'm thinking with. And so now coming back to this, are we concerned about this R3 pivot in the grand scheme of things? No, we're not bothered by it because the bigger picture is telling us where we would like to go. And even if we experience a little drawdown, we don't care because that's what a trend trader is. You basically withstand a little bit of risk for the bigger move. You have to be comfortable with that. If you're not comfortable with that, then you should switch to scalping, into the scalping strategy. If you want to be a trader and go for the more, you have to be comfortable with playing the probability and withstanding a little bit of risk. So let's push play here and see how this price action develops. So according to my 15-minute, we're setting in motion. Our 5-minute is green, our 3-minute is green. 3-minute is clearly above the HMA. These are kind of still penetrating, but I'm not concerned about that. Here we are. And I'm going to speed it up a little bit because I got a few more trades to show you. And NG can move a little, kind of tinkers along at times, and then it does the thing. But I want to show you the nice thing about NG is that even though it may seem a little slow at first, it goes to where it needs to go. It's a trendy market like the currencies. It goes to where it needs to go. It goes to those benchmarks. So if you spot them, right, and don't treat it as a scalping market. Scalping is not really good in NG because you'll sit there forever for 3 little ticks sometimes. It'll seem like, snail's pace. If you want to scalp, you want to scalp in markets like crude oil and gold. But the nice thing about NG is that it goes to its benchmarks. So the market makers take it where it needs to go. So notice here we are. Now I could have, you see this little green stripe on my dome? What that does, those are your daily high, low, and markers. If you go to properties, let me just pause this for a second. Oops. Okay. If you go to properties, again, this video on setting up your dome is in the self-paced course. And you put here show daily high low markers, set it to true. It'll show you where the high is and where the low is. The low, you can set the colors. Mine happens to be my daily high is pale green, my daily low is blue. Now, when those show up on your dome, get excited because you know where the market's going to. It's going to hit those. It likes to hit them and push them higher. If they show up on the dome, there means that the market's within range of hitting them. So that's another nice little strategy. I call it chasing the highs and lows the high-low markers. So notice it hit it. Now I could have been conservative and put my first exit point where it first was, and just taken a few extra ticks and gotten out. But what I want to show you is how the market's not really bothered by the R3 and how aggressively it will go to the R4. Now the best thing to do here is to get out just before the R4, because sometimes it'll stop a couple of ticks just before it, sometimes it'll squeeze through it, sometimes it'll hit it and then bounce, so you're never quite sure, does it have enough momentum to go all the way through, hit it, or stop just prior? So I always get out a couple ticks just below the price number. So the R4 is sitting at 40.71. I like to get out at 69 or 70. And they we just made a nice 200 bucks in one trade. There's your 5,000 a month in one trade. That happens to be our first trade of the day. Now, sometimes you wake up and it's already hit the R4. If what you got to look for, these are great strategies. If the market looks like it's going to cross the R3, ignore the R3 and get as many ticks as you can running through the R4. The same with the S3 and the S4. The market does the same thing. In fact, today it was running to the S4. Let me see if I can find one. Here we go. Okay, so here we go. We're tinkering along, bouncing around the S3, but as soon as at some point we will run all the way down. Once we hit below the S3, we'll run all the way to the S4. These are two nice benchmarks, and you want to be trading in those two directions. And the higher time frame is going to tell you it's going to be doing it. Look, this is 726 that we're running to the S4. And so if I go to my 240 chart, '26. What criteria? That didn't take a whole lot of brain surgery there. That was pretty much straightforward. Well, 26. If the moving averages are on top, our HMA is red, our Lin rigs are telling us from the day before what we're likely to do. Look where the S4 is. Know that a clear trade, generally trend trades, go for I would say three, four or more candles, if you have moving averages back in direction. So if you're in the early part of the morning and you're on candle number 1 or 2, you know that you've got at least 3 or 4 candles still to come before any price action will start to hiccup or do any pullbacks. See, look, here's 4 candles before we have a hiccup. There's 4 candles before we have a hiccup. So you can see where the S4 is. That's the nice thing about looking at these higher time frames. But again, all I'm looking for to give me predict is what criteria is in motion. Am I doing a clear trade? Is the algorithm giving me a clear trade, or is the algorithm giving me a gap trade? So I'm applying my same basic strategies to the higher time frame to give me where the majority of the price action is going to go. So 26 told me, look at your MACD going through the center lines, those are coming down. It told me where the majority of the price action was going to be. Doesn't mean we're up and down, but I know where the benchmarks are. So if I'm a nervous trader, I'm looking for these trend trades. Look at the trend trades coming short are longer than the counter trends going long. Do you see that? So from a probability factor, that's the direction you want to mostly trade. Now, it doesn't mean you can't trade scalping moves and reversals and so on. We're going to do that in a second. It seems like it's important on both the R3 and the S3 for the 13 EMA to cross them to go all the way. No, actually, not always. It does, you know, like here you can see the 13 really looked like it was going to cross. But notice the price action plowed through here before the 13. Here's the difference. The R3 is very different to the S3. The S3, there's a lot more. The S3 is a concrete floor. The R3 is a wooden floor. The R3 just requires the alignment and the momentum. The S3 requires the 13 to go through because they don't like the market. They know that when the market crosses the S3, it's going to run to the S4. And if there's too much fear in the market, it's going to not. It won't necessarily stop at the S4. And that's where flash crashes occur. It will go below the S4, and then all you have are these little intraday pivots as support points. And you know that you could have a flash crash, and then they're going to come in as a buying. So the S3 is actually a lot stronger than the R3. But what you really get is the algorithm, is the real influence on whether it's going to cross. Because if we look at this higher time frame here, let's look at our 50-minute chart for a second. I'll show you what I mean. Start to see how to activate the price already above the R4. I'll come to that in just a second. You guys have some good questions here, and I will try to catch all your questions. And if I don't answer your question, always feel free to retype it, because sometimes I go off on a tangent and I forget things. So let me show you from a 50-minute view. Okay. You notice here that from a 50-minute view, the trend is still developing. It's still early morning. It's only 7:30 to 8 o'clock. So the key factor here is if you look at its moving averages from the higher time frame, it's not really in motion. Notice here when a 13 starts to take off here, MACD is really going through a center line. The trend is really more developed, and at that point, we're ready to just plow really through the R3. So that's really what you're looking for. Is the trend developed yet, or is it still early in the move? Because here you can see we went long, 13 was very far away, and we still, the higher time frame still had to cross its own 50 and 100. So even though the price action shot up to the R3, it wasn't ready to go through it and take the run to the R4. But once the trend really, which is here, you can see here's your classic clear trade, more closer to getting through, bang, it just takes off like a horse heading for home. And that's what you're watching for in terms of timing. But nonetheless, here, remember, it doesn't matter, because at the end of the day, you're still taking your clear trade entry in terms of timing. So you're still in price action. So even if you took touching candle or this candle here, okay, you still, you know, like I said, if things change, if you see a fractal or something to get out of it, you're still taking your 3 ticks or your 6 ticks, you're still taking price action because you're following the clear trade criteria. As long as you follow the rules for entry, you're still going to take price action on the trend, regardless if it goes through the R3 and makes it to the R4 on the first try, second try, third try is a charm. Is that clear? Now, if the price action, let me just touch on this question. If the price action is above the R4 or below the S4, you're in no man's land. Anything goes. Anything goes. So it's a lot easier to trade when the market's range bound in these levels. If it's outside of the levels, you're in no man's land. And there you really have to stick to tighter targets and obey the rules religiously. So go for your 3 or your 6 ticks, and or your gap trade, go for your 3 ticks. Don't always assume that the market is ready to come down. But let's go ahead and let's do a gap trade now and focus on the counter trend for a moment, because what we're going to be watching for is, now that they've hit the R4, what are they going to do next? We don't know. You can't predict this. You have to wait for A to show up, and then you trade from B to C. I can't show you, I can just tell you that's the benchmark, and that the probability is very high to get there. I can't tell you what they're going to do next. We have to follow the rules for the strategy and the alignment for predict. Now that our MACDs at the top, look at our stows are all together. Chances are we've hit oversold now. The chances are, oops, I wanted to do this. Chances of us coming back down is very, very high. Now let's do this for a second. Notice that my 5 minute is red, my 3 minute is red. Look at my Lunreg 4 has made a nice sharp V, and I had the circle with a dot. The circle with the dot says this could be a confirmed high. Okay? Notice that my candle is already below here. Now watch this, because per our gap trade rules, the first thing you're looking for is there 5 ticks or more before you hit the 13 from the point of entry? That's the first thing you need to look for the gap trade. How much spread? Because you know what happens when you hit the 13 with such strong divergence, they could bounce and go higher. You don't know necessarily, look at this MACD, you don't know that the market's really ready to reverse just because these stows are at the top. Stows can stay overbought for quite some time before they come back down. That's the problem with lagging indicators, and stows and MACDs are lagging indicators. They just kind of give you overbought and oversold. That's all they really give you. But they don't show you necessarily the timing. Okay? So at least we know, okay, we are in the right position, which is overbought. So we expect things to come down, but we still have to follow the rules. Do we have ourselves a gap trade criteria? So we're looking for 5 or more ticks. Okay? We're looking for the tail of the wick with a dotted circle. The color of the candle doesn't matter. It could be a green candle with a dotted circle. It could be a red candle with a dotted circle. Okay? MACD must not be approaching the center line. It's not. It's actually going away from the center line. Okay? And watch for fractal or barriers. Whenever you're doing counter trends, it's best to trade off something. Trade off a fence. Trade off some barrier. So here we have the R4, and the circle means we could come fractal here. That's what that circle with the dot means. Right? And we're looking for the HFT volume bar. So the fact that we have a long wick tells us price was not able to sustain, like these bars here, price was able to sustain, therefore they have run out of steam. It's the end of the 200-meter sprint. That's what tells you HFT are they ready to take their profits. And the short list I've created for you is simple, very short list for the same thing. Circle with a dot appears. Candle with a long wick or tail has just appeared. 5 or more ticks divergence to the 13 EMA. Lunreg 4 makes a sharp V for direction. There's your Everest with brown rig. And you can also use the HMA color change, except for 1 minute timings. Now, if you want to do strictly scalping on the 1 minute chart, there's 2 places you can do it. The first place is right here on the circle with the dot, or you can wait for this HMA to change red. Get you in a little later, and maybe you're closer to the 13, and sometimes you may not be able to take it because the HMA changes color too late. So I'm going to show you the 2 scenarios. So if we're looking for 3 ticks here, and the other nice thing about counter trends is you don't always have to go into level 1. Now I've already missed my level 1 entry, my level 2 entry. I may not get filled here. Level 1 is where you put your position as a limit order where the numbers start. You can actually put it in on the counter trend at level 2 and watch the market come up and fill you. Because if you're looking for 3 ticks, now the price actually only has to move 1 for you to get your, or 2 for you to get your 3 ticks. Okay, so you have a little, you're gaining a little extra on the leverage because counter trends whipsaw back and forth before they complete, before they hit their target, because there's still so much agreement to go up in motion. Whereas the trend, if you don't get in fast, in fact, I'd use the quick buttons for trend. I'd buy on the ask or sell on the bid. So on trends, I would get in front of the line. If you don't get in fast, you get left in the dust. And you'll miss those that window of the two candle early entry. So for trend trades, I use the quick buttons. Okay, I buy on the ask or sell on the bid to jump in fast as a market order. And for counter trends, I do level 2. That will be long level 2. Or and if I miss the entry, if it doesn't pick me up, then I just jump in. What about for the what about waiting for the HMA to change color? Well, you can. There's two ways to do counter trends. I'm going to show you the old way before the HMA came down. See, we didn't, in the good old days, we didn't have the HMA. All these extra indicators have come as we've evolved as extra tools for timing. And I have to say this again, the HMA is just another tool like a ling rig. Okay, we're still doing the gap trade. So before the HMA came in, notice on this list here, you don't see the HMA here. It's not on here. Because this list was made long before we introduced the HMA. Yeah? So different indicators will give you slightly different timings. Now, and you can play with the different tools to improve and minimize your risk. For slow-moving markets, you may not want to wait for the HMA. For faster-moving markets like gold or crude oil, you may want to wait for the HMA because the bouncing back and forth is too great. So you can play with that on the replay. Now, we've missed our entry here. Let me take it back a second. Let me take it back to, I want to show you this, see if I can catch it as a level 2. 840. Okay, so let's see if we can do this as a level 2. I just want to see if it will pick me up. Okay, so here's the now I'm playing the fact that we're starting to go red at the R4. Let's wait for the circle to appear. Okay, here's the circle, and then I do a level 2. See, sometimes you're not always going to get filled. You're not always going to get filled. But what's nice about this is that it could come all the way back, because what you're going to notice is that it could come all the way back and continue to close the gap. So that's the problem with trying to just trade off the circle with the dot. Now, do the level 2. Sometimes you get them, sometimes it goes, because sometimes it doesn't always do it in one bar like that. So it's a little bit of a hit and miss, as Barbara always says. But let's try it this way. You know, if you think you don't really know if it's going to go straight away, what you could do is, let's do it one more time. With counter trends, you know, you just never know. So if I just jump in here, oops. Okay, as my, I see the circle with the dot, now I'm in, and now I'm going to be going for my 3 ticks before we hit the 13. I found the HMA flattens out right before the color change. Is that valid? And there I just got my 3 ticks. Notice I'm out just before the 13. That's all I'm looking for. That is a classic scalping trend. As soon as you see the circle with a dot, there's your line rank 4, and there's 5 or more ticks to get in on, and you're looking for a 3 out of 5. So you got a little bit of a window there before things bounce. Never go for the last tick because especially on strong trends, sometimes it doesn't always make it to the 13. So I like to get out just before that hit the 13 if I'm doing a classic gap trade. Now that is our classic gap trade. It's called a retracement and it ends at the 13. Now the gap trade criteria is over. The flattening of the HMA is just a byproduct. It's just, it's same with the Lindwig turns before it, does its thing. So if you look for that, that's great. Now the HMAs change color. However, we're on the 13. I'm not going to take this trade because watch here. Let's see what happens here. I may or may not get 3 ticks. Okay, not without some risk involved. Here the HMAs just change color, but I'm already on the 13. And if I look at the divergence, we might not be ready to close, do a proper reversal now. See, now I'm incurring risk because we hit support. This is a support point. 13 is now support on a counter trend. Okay, and sometimes these candles go all the way up and test the resistance. See, now I'm incurring 3 ticks, 4 ticks risk, 5 ticks risk. Now watch it. It could incur, it'll go up and test this resistance level, and if it's truly ready to reverse, we'll hit it and then turn around. But sometimes it just goes up and continues above the R4 and continues the trend. How do you know what it's going to do? Just because these stows are at the top here is not a guarantee that this is going to reverse. Look at this divergence. So this is a lot of risk to sustain. A lot of risk. Which is why I want to clarify the timing of the counter trend. You only have the classic counter trend, which is you get on the circle with a dot, which is giving you a confirmed high, and you get in and you get your 3 ticks before you hit the 13. Once you're on the 13, you're too late. So if you're looking for the HMA to change color and to do the reversal part, I wait for the 3 minute to go red, 2 candles red. There's my first candle. I'm waiting for a second red candle, and I wait for it to be below the HMA along with my stows and MACD lineup. Then I know that we're likely to reverse, and that's when I'm ready to do a second leg on the counter trend. So you can actually do 2 counter trends here. You can do 3 ticks, and then you can wait for this criteria. So let's just see how that develops here, and you can see exactly what I'm showing you. The 3 minutes giving me a second red candle here. Notice that the price actions go below the HMA. Now we're south of the HMA. There's the HMA. These candles were north of the HMA. This candle's now, the body of it is below the line. Okay. Now, here's another circle with a dot. I'm expecting this to go short. This is where I more likely enter, so I avoid this kind of whipsaw and risk. So let me say that again, so you can understand the difference on counter trending. As a rule for counter trending, you never want to enter on the 13 if you don't want to incur any risk. You don't want to enter on the 13 because as a counter trend, that 13 is always treated as support or resistance if you're going in the opposite direction. So the candle is going to bounce regardless. It's going to bounce. Could be a small bounce, could be a big bounce. It could even bounce and continue the trend. So because you don't know which one of the 3 it's going to do and how much of it, you just got to treat it as risk. So there's a golden rule: never enter at the 13. If you want to steal a scalping trade, take your 3 ticks, you enter from the point of the circle with a dot, following the counter trend criteria, as long as you're grabbing your 3 ticks before you hit the 13. That's your classic scalping 3 tick gap trade. Now, we've added the HMA to help you see reversals, which means you get a second opportunity. So what I would do is wait for the green to show you that it's hit and tested that resistance at least once, sometimes twice. So you'll notice that sometimes you get two green candles, then you'll get red, sometimes you get one, but wait for this gap to finish and wait for it to test resistance, and then it starts looking like, okay, now those are ready to cross, these ready to come back down. Now you're looking at, instead of a retracement gap trade, you're looking for a reversal, another opportunity to get in on the counter. And what helps to confirm that probability is I use the 3-minute timing as my matchy-matchy. I always look for a secondary candle, so I wait to see the first one, and I wait to see that it's below. Now you notice there's my entry position. We could take, in fact, I'm going to show you, let me see here. I'm going to get in 2 contracts to show you how much you can get. Okay. So it's still vacillating. Still balanced either can get it a second time. You're going to incur some risk here because you're entering on the 13th. But what you're trading is the probability factor that the market is going to reverse direction. This is your perfect trade. And what you're looking for is the HMA to be red, and you're looking for your MACD and your STOs to confirm. Thank you, DT. DT says, when are you going to play the game? What is it? Yes, we'll play that in a second. See, look, yeah, we're still testing, and this is very dangerous. Look, we could run up to the R4 still. It's not quite ready yet. That's the problem you have with counter trend. It could go up and test that resistance more than once. Now notice on the 3-minute chart, all it's doing is it's testing that resistance point. So let me speed it up a little bit more. So expect that kind of risk on counter trends. That's what counter trends do, which is why I prefer the trend. You get a lot less risk on the trend. The only time you have a problem with the trend is if you're late to the party. As long as you're trading as close to those 13 and 20 crosses as possible, you catch the meat and potatoes of the party, and you will experience less risk. Okay, and this is where people run into problem on trends. They get in here and they think they're going to do a second leg to the R4, and we're not trading here. Let me just explain this. Here's a touching candle. Here's a touching candle. Nice opportunity to do a second leg on the trend. Right? Here's the problem. Look at your MACDs on the top. Your STOs are already coming down. You could have some price action go to the R4 again and higher, and many times it does. But what do you notice? How do we know that this is not a good opportunity to do a clear trade? Instead, we're looking for reverse. How do we know? Who can tell me? Let's see who's been paying attention here.
The other one's green.
Yeah.
But that's with the red on top.
Yeah.
Why enter before the 3-minute HMA change color? I'll come to that in a second, Andrew. How do we know? HFT, Jeff got the angle of 13, the higher time frame. I think it's going back to the R4 because the price is north of the HMA. Well, you see, that's the problem. The 1 minute is showing you north of the HMA. It could absolutely run to the R4. The LR9 is still below the HMA, so that's a nice clue. You could use that. But the LR9 is a lagging, a slower indicator, so it could take some time to cross. Excellent, Michael. Michael's the only one. Michael and Jim. Oh, 3 minutes. Michael and Jim, you get a double chocolate chip cookie. Everybody else, you get a CUDA, but not a cookie. Right? The answer is, ta-da! The 3-minute price is below the HMA. 3-minute price is below the HMA. Remember what I talked about in the last class, being north of the border, south of the border of the HMA as your basic rules for support and resistance. Okay, again, you're fizzling out the low probability maybe moves, and you only want to trade high probability moves. So let me just find that document for a second, because I need to have that clear. And if you want these PDFs that I created, just email me. Don't email Shadow Support, you drive them bonkers. Just email me and I'll give it to you. Basics for support and resistance. Okay. What was the golden rule that you had to follow for high probability trades? Remember, your HMA is also support and resistance. It's a trend line. Anything that's a trend line or a pivot is support and resistance information. So look at the position of the candle in relation to the direction of the HMA color change. And Lindbergh 9 indicators before entering a direction. Ask yourself, am I north or south of the line? And do I have enough space before I hit the next barrier to get my ticks? If you want me to send you this, then you have to email me, right? So, and remember, for trending information, what's the rule for trending information? If you're looking to do a trend trade, what's the thing that's very important on the list? You must have 2 or more time frames in sync. You must have 2 or more time frames in sync. So, I ask you, if we were just looking at this criteria, do we have 2 or more time frames in sync? The answer is no. Why? Because the 3MA, the 3 minute is south of the HMA, and over here, when we did our little sexy trend trade where we made our $200, what was the 3 minute position at that particular trade? Well, the candles were north of the HMA, so they were in sync. You need to have in syncness for trending. This is where you get caught on trend traders. That's how you know you're trading at the end of the party for trending. You are trading at the end of the party if the 3 minute tells you one thing and the 1 minute tells you another. The only thing you should be looking for is things to peter out and go short at that point. Now, somebody just typed in and said, what about waiting for the 3 minute HMA to change color? You can to minimize some of this risk. You can. And we're going to do that now. We're going to follow this and see how this plays out. How much risk are we sustaining with this direction short? So you can fully understand the timing of counter trending. Now, I also like the fact that we also look at my 5 frames across the board, my 15-501. Notice that they're all red candles. Now, candle color doesn't always hold. Just because it's red doesn't mean it stays red. It could go green. So you can't always rely on it. What you really need is trend line information, your short-term trend lines like your HMA, your Lindberghs, on top of candle color. So candle color just makes me feel more confident that I'm not going to bail from this trade just because I have 2 ticks against me. The fact that they're all red means I'm going to suffer this risk, and I'm going to ride this puppy out. Makes me feel more confident to stay the trade. So always matchy on trend trading and 3 and 1 minute charts. At the very least, if you add a 15 minute or a 5, it even improves it more. But always matchy on trending on the very least a 1 and a 3 minute chart or a 1 and a 5. They'll do the same thing. The 3 minute will fine tune it better for you. Okay, so now we've got our 3 ticks. Now what we're asking ourselves, and notice that the 3 minute did in fact change color. Did in fact change color. So you can use the 3 minute HMA changing color here. You might get in a little later and still be hoping for your 3 ticks here. I like the fact that I'm already in and got my 3 ticks. So I'm ignoring risk because I'm already in and I'm going for my 3 ticks and a little more based on the fact that they're all red, based on the fact that my candles are south of my 3-minute HMA, and then when it changes color, I'm going to go ahead and get a little bit more price action. Now, what I'm betting on, in fact, is it's going to go down to at least the 50 on the 1-minute chart. At least, close to it. So I want to be out not exactly at 454, especially in summer doldrums. You never want to go for the last tick. Always get out a couple ticks before the barrier. Whatever barrier you're looking at, because you want the market to go through you before it hits its benchmark. That way you guarantee your fill. Because when there's light volume, you could be number 1001 in the queue, and it may only buy 1,000 contracts, and you get left in the dust. So make sure in every move that you do, the market has to go through you to reach its target. So that's the reason I always go for, and even I always go for 2 ticks less than every benchmark. And even if I see it starting to dilly-dally, sometimes I'll move my target and just get out. Take a little less. Just so that I can take my profit before it really bounces. Grab the meat and potatoes before it really bounces. And there we just made $100 on the counter trend. So the nice thing about what I just demonstrated is that you have 2 types of counter trend. You can do the first part as a strictly scalping 3-tick strategy, grabbing 3 ticks before you hit the support of the 13 inside a 5-tick spread, and it's very fast. You get your 3 ticks in a flash, okay? And then you can also do the reversal part in the MACD. Look, there's your MACD crossing. Your stows are going down very nicely. And usually on the reversals, you can trade all the way to the 50, wherever the 50 is sitting at. Sometimes it's really close, sometimes it's really far away. But you can usually get a whole lot more ticks. Now notice, see how it's bouncing here? So a 6-tick range is a good benchmark. So there I made 9 ticks by doing it 2 contracts, 3-6. So you can always go for a little more on reversals. Now, reversals, this is a reversal on the counter trend. So let me just clarify this. This is our reversal on the counter trend. Reversals will give you a lot, should most of the time give you a lot less risk, a lot less dilly-dally stuff when you do them go in the direction of the moving averages. So let's talk about this here. Let me just do this. If I was going to enter as a reversal here, notice we're coming down, and I was going to trade here and ride it through the 13 EMA cross, I'm going to get a lot less dilly-dally going with the moving averages as opposed to going into the moving average. And this is the true definition of trending versus counter-trending. Now, prices still could continue lower, coming down here, but it's going to bounce around a lot. Whereas going with moving averages, it's going to be a lot smoother. Now, this is where Spreader is going to help you. Because if you want to catch these reversals going with the moving averages, all you have to do is have your 1-minute chart up, have your Segredo chart up next to each other, so you can have a setup like a 1-minute chart Segredo and a 3-minute chart Ninja. That's all you need. 1 in the 3 and 1-minute Segredo. Very nice workspace. And all you have to do is look for the blues and the yellows on the oscillators, going with your number 1 and number 2. And when they concur with your 3-minute and your 1-minute, you can trade just that as a formation, as an algorithm. So you can actually just trade that same self-organizing pattern. And if you pay attention to my higher time rule, where you're looking for things to go long, based on your 240 or 120-minute chart, you can look for these on your spreader. Every time the yellow, in this case we're going long, so we'll be looking for the yellow oscillator giving us a 1 or a 2. With our 3-minute going green, we could be riding these and going for a whole lot of. If you happen to notice the R3 running to the R4, you could be going for a whole lot more. I've been getting into the party late. Which matchy gave you courage to go short? Which matchy gave me courage to go short? Well, whenever I'm going in any direction, at the very least, I must have 3-minute confirming color candle and ideally HMA. At the very least, I only stay a direction based on my 3-minute HMA color change and color candle at the very least. Now, when I add the 5-minute, which is my next point I want to make, so pay attention here. When I add my 5-minute, notice that it's just starting to change color. And my 15-minute, now I can safely say that we could be going even, we could be continuing short a little bit. Okay, we could possibly go all the way down to this 200. Because the next time frame higher also has to complete its gap trade. But since the 5-minute has already closed the gap, I'm pretty much most of the time done with my gap trading. Because when I look at my 15-minute chart, I then sit on the sidelines and watch to see if these Linregs cross that HMA before I go short. Because I've seen when you're going with the trend, the 50-minute will give you one red candle like this, and then it will shoot up and go back to the R4. So you want to be careful here. So here I want to look for at the very least for my Linregs to cross on that 15-minute chart, especially the Linreg 4. Okay? Before, it's best to just trade what you have in front of you. Here, based on your 3 and your 5-minute have to close their gap criteria. Now this could continue, this will reverse, this will cross the 50 and the 100, go down to the 200, based on what the 50-minute is going to do next. So I have to wait and see. You'll probably find a little bounce here, because it's not quite ready to come down yet. It could go green and go up to the R4. So we have to watch for that. So let's see what happens. So the matchy on counter trends is always look to see if the next time frame has closed its gap. Has it hit the 13? And usually now the support of the 5-minute 13 EMA and the 3-minute 13 EMA will usually cause a bounce. So let's watch for that. Unless the 15-minute is absolutely decided to go ahead and close its gap. So comparable the time frames, yes. The color candle, the fact that the 15-minute was red, the 5 was red, the 3-minute was red, and the 3-minute HMA told me that the reversal was ready to rock and roll on the 1-minute. So that means I could trust the stows and the MACD for my perfect trade criteria. Remember, all we're talking about here on reversals is that the 13 and 20 are going to cross. The fact that we're adding the stows and the MACD as an alignment is really just telling us we're at the end of the party. We're at overbought, we're at oversold, we're at the end of the party, and we're ready to change. That's all that information is adding to the criteria for you. Okay, so here comes the bounce. So let's want to do another trade for you. So I really just wanted you to see what is a good trade, what is the difference between a gap trade and reversal, and what are the timing issues that you're faced with. So let's move along to, we're going to fast forward quickly, we're going to watch, there's the bounce, now it's going to, see, there's the bounce off the 100, and look, the 50-minute did come down and close the gap. Now it's going green again. So now we're not sure, are we ready to go long? Now, what do you notice at the moment? Check D's flat across the center line. Your moving averages are in the 50 here. So I'm always careful. I'm very, very careful here. Notice where your fractal is. See how flat the fractal is? It's not always a good sign. Whenever you see in trend changes like this, when we clearly have a counter trend here, notice the candle is still below the HMA, the Linreg is below this HMA. This is where, if I'm not sure, are we going long right now back up to the R4, or are we coming short to that 200? When you're in these maybe zones, I always go check other information. We close the 50-minute gap. Now this is where I go check with my 60. 60 says we're still going higher. We're not quite ready to change red yet. And so what I'm looking for is to see if I have a clear trade or a train trade setup. So the fact that I had the fractals there, not a good sign. The 3-minute could tell me I could go from 60 to 66. Here's the 3-minute fractal as well. So I'm checking the other time frame fractals to see resistance and support information. 5 minutes says we could go all the way to 71. I want to wait to see if I have a nice green candle here and a nice green candle before I bet the odds that we're going to go all the way to the R4 again. So I pause. I don't jump the gun here. I don't anticipate when I'm faced with these scenarios, because we already hit the R4. Now we're in the maybe zone. Now we're in the fight for the bulls and the bears direction. Let's see here. And those fractals are a huge clue. See, on a previous move, the fractals were strong trajectory at 45 degrees going up. When the fractals are so close to the price axis, flat almost at 90 degrees, horizontally, sorry, at 180, then you're not looking to jump in on a trend. That's where fractals are really, really helpful. And look, pausing for that second candle, don't just jump here, pausing at your red. I know I'm not interested. There's no real interest to run to the R4 at this point. See the 50-minute chart, candle still price. I want to see this green candle go pushing through that HMA before I even consider taking a touching candle here on the 1-minute chart.
No, I know. No, we're just a trending person.
So now we're going to continue lower. So circle with the deficit fractal. Fractal's holding true here. Got an asterisk. Says it's a confirmed high. I'm waiting for here is the price action's going red here. And didn't really have a nice entry to work with. So 15 minutes has already closed the gap on the 13. So let's look at this. In terms of all the opportunities I could pick in the market to guarantee my fill, remember, you want to be selective to improve your probability factor. You don't want to just chase red and green stuff. So in terms of, out of all the wonderful things I could choose from, do I really need to trade this? It's not really a gap trade. Do I know we're right on the 100, we're on some pivots, we're going to hit 200 in a heartbeat. This could be hitting support here. This is already on support with bounce and whips in a flash. Is this really something I need to trade? The answer is no. Instead, what I'm looking at in terms of information is the 50-minute just completely closed the gap now. So we hit support, still divergent, still got majority of the moving averages, MACD still strong. We could absolutely bounce here. So now, what am I looking for in terms of strategies? This is where your knowledge of your self-paced course Where is that window? Did I lose it? Hold on 1 second here. Your knowledge of your self-paced course is really going to help you, because don't cut corners, guys, and just engineer yourself. Don't become an engineer who just try to engineer the strategies and price action. Really look at the different things, because now you're looking for formations. You're looking for self-organizing patterns that repeat themselves day in and day out throughout the week across different markets that you can latch onto, so you're not chasing red and green stuff. So you want to learn these self-organizing patterns. So your knowledge of your self-paced course. So now if you go to section 5, the strategies are further defined. We've just gone through what a clear trade is, what a gap trade is, what a reversal is. Now we know that's what we're really looking for. Clear trade, gap trade, reversal. But we're also further looking for, within the algorithm of the market, when do I have good opportunities to choose a good clear trade, a good gap trade, and a good reversal. That's what the section 5 is going to help you to choose. So if we go to, if I just look through, I'm not going to go through all of this, we don't have time. You can do this in your own time. But I'm going to give you the answer to what it is I'm predicting coming next. See, now I have an element to predict. Ooh. Strategy number 7. Could we be facing a 200 SMA bounce? Well, let's look at matchy across the board to see if there's a clue. The fact that we're closing the gap, got support here, MACD still strong. 13 hasn't really crossed. Notice 13 is still green. There's still divergence here. Hasn't really crossed. So, and we don't really have all the moving averages back in the direction short here. They're all kind of flat. So when they're flat, there's no real trend to speak of, is there? There's no real downtrend. So the probability factor of us bouncing off the 200 is very, very strong. Also, if we look here, if we go back to our 60-minute chart, oops. Matt gets a cookie called the 200 moving average bounce. Excellent. If we look at our 60-minute chart, right, we're experiencing a little pullback because it's getting through its 50. It's not able to get through its 50 yet. There's a little pullback here, but the trend is clearly still predicted up. If I go to my 120, we're still green, and we know that the direction at this point is still a little reversal up. So all I'm looking for is short-term moves within a long-term direction. Because I know there's more long than there was short today, there is going to be some short. But for right now, there's more long. And there's one other thing I have to say about the 120-minute chart or the 240. Let me make one additional statement, which you have to watch for. And it's this. There's a big difference to the day's trading, how your day's trading is going to go when the higher time frame is doing its clear trade versus its counter trend trade. So here's your retracement gap trade, and here's your reversal counter trend trade. So we have, on these days, we're all about counter trend, and on these days, we're all about the trend. There's a big difference to how your day's trading is going to go when you look at the 120 or 240 or higher, and if you see that it's a trend versus a counter trend, that's all you need to look for. What does that tell you? Who can tell me what the difference is? What piece of information am I looking for? That's going to help me when I'm choosing my opportunities. Who can tell me? Who's been paying attention in my other classes? Counter trend dilly-dally. Kathy, you get a double chocolate chip cookie. Price with the 13 EMA. That's good. Yes. So remember, what you know about dilly-dallies, I've already just demonstrated for you on the 1-minute chart. It whipsaws. So on these particular days, you're going to have up and down trading throughout the day. On this day, it's more of a one-directional day. Just look for opportunity to go short. On this day, look for opportunity to go long and short. Does that make sense? Bumpy ride. Yay. Yay, my first cookie, Kathy says. Good job. That's the important thing that we're looking for, and understanding, as I have already demonstrated your two strategies, that's for the, that's knowing how to use your strategy. So now we know that because we're on a counter and reversal, it hasn't quite crossed yet, we're not really on the other side, we have runaway stow here. These basics are telling me that I can expect an up and down. So we close the gap here. Okay, big deal, close the gap. The primary move is still to go long mostly throughout the day, but I'm expecting an up and down day. So I'm going to take advantage of short and long. But for right now, I'm using support information to tell me I could have a nice bounce trade. So now we're going to play the what is it game. So let's watch here and see what strategy are we looking for. We know we're looking for the 200 SMA bounce, right? Because the 200 is a concrete floor. And especially if it's next to the PP like that, we got two red, well, we can just expect a lovely bounce off that. All we have to do now is decide what strategy we're going to trade. So if we're looking for our basics of our two strategies, oops, gotta find the right document here. We're looking for a gap trade or a reversal. We're trading the 200 SMA bounce in terms of an algorithm strategy. At the end of the day, we're really looking to do a counter trend. So what do we have to do? We have to wait for the circle with the dot to appear. We have to, and ideally we could even wait for the HMA to change color. We look for the Linreg 4 to make a sharp V. And notice that our MACD has cleared the center in here. Stows an arrow at the bottom. I'm going to hasn't quite made it all the way yet. So it's telling us we're not quite ready to go just yet. Now the 100 is crossing that 20. The 100 is almost, didn't quite cross the line yet. Okay, so now we have the HMA turned to green. Notice my 3-minute is green. Okay, my 3-minute is green. And there is some price action. I could do a 3-ticker here, but notice that it's kind of tight. If you jumped in here based on when the HMA turned green, you could have taken your 3 ticks by the time you hit the 13. So now, the fact that we've closed the gap, we really want to wait to see if we have a reversal. Because if you take it, that's fine. But let me ask you, how many of you wouldn't take this trade because of the 200 moving average? So there are a lot of me's. Somebody says, I thought we shouldn't trade on the 200 SMA. I would. Well, let me ask you something. Okay? It's true. I always say never trade on the 200 moving average. Okay? As a rule of thumb. But what we're looking at in this particular scenario is we're looking to enter as the bounce of the 200. The other thing we're looking at is the 200 is what? Is the 200 SMA support or resistance at the moment? The 200 is still support. Can you see? Notice it's still lighting color. And remember, on our basics of support and resistance rule that we did in the last classes, the rule is must clear the line by 2 ticks from the lowest part of the candle, the highest part of the candle, depending on the direction you're going. So wick or body. So in short, notice these wicks were all touching. Even though the body of the candle was below the 200, the wicks all touched. So the 200 never changed its properties from support to resistance because penetration never occurred. Penetration is only considered true when the wick or body, the highest point of this candle, because we're going short, has cleared the border by 2 ticks. So now you could say, okay, this is support. I'm going to do a little gap trade and steal 3 ticks here because this the 15 minutes across the board, everything's going to bounce off support here. This is all support. Okay, you could do that. Or we could wait for the 2-tick rule and look at the possibility of doing a reversal strategy based on the 3-minute giving you another green candle. So let's see if we can do a reversal strategy here. Now, this is tricky because we are trading in barriers. We are trading in amongst the moving averages, and it's all so. You want to get in and take your 3 ticks and get out in these scenarios. So let's watch here to see if we're going to get more bouncing here. And this candle right now is at 50, the 200 is at 48. So this candle has in fact cleared at the 2-tick level, north of the support. So if I was going to stick to the 2-tick rule, and it is advisable for you to do that, I would be trading this 2-tick rule here. So I'm going to wait till now the thing that I don't like about this particular trade, okay, is we are technically out of sync. Can you see that the 5 minutes crossing down, the 3 minutes crossing down, the 1 minute's crossing up? Even though we're getting a perfect trade scenario, the other thing I didn't like before was the 3-minute was not north of the HMA. Notice right now that the 3-minute candle is pushing north of the HMA. I'm not worried about the R3 pivot as much as I'm worried about other moving averages. In this scenario, the R3 is not a major concern because the market likes to push through the R3 and go to the R4. So we're at C9, we're at 48, we 1 tick apart here. Now our 3-minute is pushing through, or we could have already gotten our 3 ticks here. But am I going to squeeze another 3 ticks? It's kind of dodgy. I'm in slightly late here, but at least we're clear of the 200 moving average, and our 3-minute chart is above the HMA. Can you see that it's pushed high? 3-minute has changed the HMA, and my 5-minute candle is green, my 50-minute is bouncing off support. So it's trading the bounce to the 200 is a very nice opportunity to steal some ticks when you're in sort of a gray area in terms of moving averages. You're in between moving averages, you're not quite sure where we're going, but you really want to wait for that 3-minute to, again, give you those green candles, and those are at the bottom. But it's really just I will just treat it as a scalping opportunity. It could go higher, but the 3-minute is going to confirm that it's going to do that. And you could enter here because of the 200 support doing a gap trade, trading your 200 SMA bounce. So go through that section 5 and read through how to find the good clear trades and good gap trades, because it's clearly explained in section 5 in terms of self-organizing patterns that repeat themselves. So let's do the run to the 200. Let's see if we can squeeze in one more trade before we run out of here. Are there any questions about that? 5-minute chart now has a fractal and 1 minute doesn't. Do we respect the fractals? I always like to I use fractals only when I'm looking for an entry or an exit. I don't use them on everything all the time. So you enter first green bar on the 3 minute. You could as a gap trade, you could enter the first green bar on only because we have the support of the 200. Remember, whenever you're doing counter trends, you always want to be grabbing those counter trends that are trading off strong support and resistance. The probabilities are very, very high. You don't have to wait for everything to be a-okay before you take them. The fact that you have so much support there, and the 50 minutes giving you support, and this is green, you can gamble with this. I could have gotten in here and taken a few more ticks, or like I said, I could have obeyed the 200, the 2-tick rule and scalped 3 ticks in the later part of it. Either or is acceptable. But what's allowing me to take this trade is the fact that I'm trading off the support and I'm trading the 200 SMA bounce. Now we're going to do the, let me see if it's on here. We're going to do the run to the 200. SMA bounce, bullish and bearish. So let me see. 200 SMA crosses. Reversals. Reversals are your perfect trades, guys. Those are your perfect trades. It's all in there. You want to go through, I'm just trying to say they talked about the 200 there. Okay, let me try to do the run to the 200 because there's with the 200 there's 3 strategies with the 200. There's the bounce off the 200, there's the run to the 200, and then there's the when the 100 moving average and the 200 are crossing. You want to look for those. In the direction of the cross is where the market will go. So you see here it's crossing, so that means the market's going to go long. So those are the 3 strategies with regard to the 200 timing. So let's do the next one really quickly here, because it's going to happen real soon. So now that we've hit the fractals on the 1 minute chart, we're doing a gap trade, right? We're coming down and we're doing a gap trade short. Notice that the 3 minute never crossed the 50. The 5 minute is still resistance. The color of the 13 EMA is dark green on the 5 minute chart. Therefore, it's resistance. It's not light green. That means we're coming down. We're coming back down. And so I could be doing this gap trade going forward to the 200. Because the 13 across here, so it's kind of coming right back down. The 13 is resistance, this is resistance, and we're still in a gap trade. Even though we bounced off the support point, we traded that, I could also be doing the trade and ignore everything that's in its path. Because it's all governed by the higher time frame. Do you also have to wait for the 3 minute HMA to turn green before you enter to match the 1 minute HMA? No, not always. You don't always have to. You can trade off just the color candle on the 3 minute and you can still very effectively scalp 3 ticks. But the timing of your entry, sometimes if you're on the money, you'll get your 3 ticks in a flash. Sometimes if you're late in the bar, if you hesitate too long, then you might experience a little risk, as I demonstrated earlier. And then it might be better to wait for that 3 minute HMA. See, when I showed you these trades here, if you're on the money, you don't care about the 3 minute HMA. You'll steal 3 ticks on gap trades all day long. You just need a green candle, a red candle, or a green candle in 3 minutes. Okay, and you need the circle with the dot, the criteria for the 1 minute. It has to be there. Then if you wait for the 3 minute, then you're trading in this part here. This is where the 3 minutes in. You're actually doing the reversal. By the time the HMA comes in on the 3 minute chart, you're doing the reversal part of the counter trend. Oops, that's my 5 minute. Okay, here. Can you see here? There you can see my arrows. See, I was trading on the first red candle. So as long as the candle is red, I can scalp trade all that off. It gives me enough agreement to steal 3 ticks. That's what that red candle in the 3 minute does. But as long as the HMA turns red and it's still doing its gap trade, well, now we're talking about a trend change on the 1 minute chart. All right, I want to fast forward here. So there's the bounce off the 200, the run back to the 200. Yeah. And I want to show you another trade really quickly. C2. With the 13 going above the R3 around 9:30 and 3 minute matching, why not look for the run to the R4? We did. You must have come in late. We did. We traded that. We did do the run to the R4. That was the beginning of the class. Oh, you're talking about here at 9:30? No, not. That's a good question. Somebody said, why not do the run to the R4? Well, remember, we already ran to the R4. We already did it. You see, look, when you go through the morning, and you look at it from this, we already did the move prior to. They're not, you can't always bet that they're going to do it a second and a third time. They're only going to do that if the higher time frame confirms. And right now, the 50-minute is not telling you we're interested in running to R4. Okay? The 50-minute is telling you it's time for a counter trend. We've done enough trending. Look how many candles we trended. 1, 2, 3, 4, 5, 6. Time for a counter trend. It can't just go one direction. It has to do both. What goes up must come down. What comes down must go up. Okay? It's the laws of the algorithm. So in order, you can't just say, okay, I've got some green stuff, we're at the R3, we're going to run. Remember what I said earlier in the class, when it comes to trending, what's the golden rule to know when you have a real trending opportunity on your hands? What's the golden rule? You can tell me. See if you can pay attention here. What's the rule that's above all rules to tell you you really are in a trend motion? I'm going to go one person. To enter or exit, you put more emphasis on the 1, 3, 5, and 15. I'll put that. 3 or more moving averages, MA's backing, 1320 cross, all moving averages in direction, moving ever, 3 averages fanning upper time. Okay. Some of you have given me good answers, but they're not the one thing I am looking for. Okay? The golden rule to know that you're in a trend is, yes, you must have moving averages. These are criteria for entry. You must have the 13 degrees. Criteria for entry means you can't pull the trigger unless you have it. But to know whether you're in a trend is always this. 2 or more time frames are in sync. Matchy. And the more, the better. Okay? So although you said higher time frames, you get a cookie. Chocolate chip cookie for you. So somebody asked, what's more important for entry, 1, 5, 3, or 15? Either. Doesn't matter. All the above or either or doesn't really matter. But the 1 minute will help you to get in nice and early. And as long as you trade the 1 minute nice and early when it is matching. See here at 8:30, the 3 minute was matching. The 15 minute was clearly green. That's a wicked. Green, green, green. Matchy, matchy across the board. Now we know the run to the R4 is very likely. That's the key thing with higher time frames. Right now we're on these moves. All I'm doing, look at the moving averages. If you compare the moving averages to here, can you see that on the 1 minute, these moving averages are nicely organized, ready for a fist to fan. These moving averages here are higgledy-piggledy. They're all off sorts. One's coming down, one's going up, they're crisscrossing. We're not really in a trend formation here. So all I'm looking for is scalping. 3 or 6 ticks at the max. And I'm really just doing bounces. These are your bounces off the 200 strategy. And I would just be scalping 3 ticks there. Very different scenario. It could, look, this one almost made it to the R4. It could, but you want to be paying attention to fractals and things like that over here. This fractal in there, I've traded to the fractal, not the R4. And when we're going into lower highs here, can you see? There's the high. It could have gone for double top here, but we're really trading off higher life, lower highs. And the 15-minute told you, here's your 15-minute asterisk, giving you confirmed high. So the fractals that I really look for to give me support and resistance information are the 15-minute and the 3-minute. And the 1 minute just helped me fine-tune my timing. But if I see that they have formed, I obey them. You must respect your 15-minute and your your long-term and medium-term fractals, your 5 and your 3 and your 15-minute. If you see them there and you see those asterisks, don't expect things to be running up just because you've crossed something. You must respect them. And then, of course, the HMA information. Hope that was clear. Now, moving on, let's do one more trade quickly and then we have to wrap it up. I'm just trying to choose a juicy one here. Reversal short, CT short. Let's see here. Okay. So I'm just showing you, okay, yeah, this is a good one. We're now going to show you a trade short, but waiting for we cross the major barrier. As you can see here, remember what I said about concrete floors? Notice that the price action over here, this is very important when it comes to trending. So the first rule we talked about trending was higher time frames in sync. Now, at this particular moment in time, we're in a trend change. So we're changing from the bullish market back to bearish market, and the moving averages are now just forming as they should for trending. Can you see that coming nicely organized here, getting ready for a nice fan? Trajectory is forming on that 50. There's a nice trajectory on that 20. Nice trajectory on that 13. But why didn't we continue short over here? See, this is really a reversal trade to the 200s. Why did we not continue? Notice that the price action, even with all this momentum, literally stopped on a dime. Because we hit a double barrier, the PP and the blue pivot together, and it's a concrete floor. It's a concrete floor. What's the rule for concrete floors? Remember our document? What's the rule for concrete floors? The PP, the S3, and the S4 are stronger than other pivots as barriers and require the 13 EMA to cross it before penetration will hold true. The rest of the pivots only need momentum and a beginning of a move. Yeah? So I'm now looking at an opportunity for a trend. Notice that my 13 has crossed my PP. Notice that I have a touching candle or the very next bar. I also have a red HMA. My Linreg 9 is going. I had an asterisk at the top of this green fractal here. I've got all the ingredients to confirm I have enough resistance to go short. Notice that my 3-minute is pushing through my HMA. It's red. My HMA is red. My 5-minute is already below my HMA. Huge clue. That's why I say you do the 3 or the 5. They're both going to confirm. Okay? So sometimes the 3 is going to be more crystal. Sometimes the 5 is going to be. As long as they're pushing through, they're the right color candle. And somewhere, some time frame, medium or long term, is already through that HMA. We never went north of the HMA. According to the 5-minute, we were always in short based on that HMA. Now look at our MACD and our STOs. We're still coming down. Okay. And our 15-minute is still clearly red. So we have matchy across the board. So we have 2 or more time frames. 2 or more time frames are in sync, which is the main ingredient for a trend. And along with the touching candle and all that other good stuff. Now I would like to catch the top of this bar because I am into the second candle already. I could get a little whipsaw here, but that's okay. I'm going to show for the purpose of the demonstration the simple fact that we crossed that PP and we have this much red across the board. We should get some price action. What about the STOs on the 1-minute chart? Like I said, STO lagging indicators. They can stay on the bottom forever and they can stay on the top forever. When it comes to reversals, where we look at the STOs and the MACD, it's very different to your basic clear. Remember what you may not have caught this. I said it at the beginning of the class. There we just got our 3 ticks. Sorry, my dog's playtime at this time of day. What I said earlier in the class, when it comes to trending, I don't always need the STOs and the MACD for clear trading, okay? Because the trend can continue and the STOs can stay on the bottom. These are lagging indicators. What we use for the STOs and the MACD for is to say that the trend is over, and we use it for our counter trend. Sorry, somebody says go for 10 ticks. Well, look, here's my low of the day. So the market is chasing a new low. They're chasing a new low. I could technically push the envelope and put this price action. They may hit it, they may not, just above it. Yeah, and go for a few more ticks. See, they go all the way down there. Going down there to chase a new low. Remember, whenever you see those in range, they like to go and hit them and push them slightly lower or slightly higher. There. I call those chasing the lows and chasing the highs. So it went down to the previous low. I'm not using the MACD and the STOs for classic clear trades. These are your classic clear trades. The STOs and the MACDs, I've never used them for trending. Never, ever, 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 ever use them for trending. Okay? You can use them as an added piece of information, things like, are we going through the center line, so the trend's continuing, and things like that. MACDs and STOs are really used to tell you it's time to do your counter trend. Now, there's 2 types of counter trends. There's the gap trade, and then there's the reversal, which is really a marriage between the gap trade and the new trend developing. So you're going to hear Barbara say, well, it's time for trending, but what she's really saying is that it's really the counter trend and the new trend is developing. And the only way you can tell when the new trend is developing in the new direction after a previous trend, that things have officially petered out, is when you get this alignment where the MACD and the STOs are either over or oversold. And they're showing you've hit all the top, but at that particular point, what do you see with the price action? You see that we are actually in a reversal strategy. The HMA is going towards the 13, the 13 is going towards the 20 SMA. We're in a reversal strategy. So we're not talking about clear trade here. We're not talking about clear trade. We are talking about gap trade here. The trend is developing, the new trend in the new direction. So it's really a counter trend. But we have to break it up into sections so you understand timing. And the way we break it up is we say you either gap to the 13, and then you wait for the crossing to happen, and then you reverse. The new trend is developing. That's what using the MACDs and STOs for. But notice over here on my beautiful $200 move that I made earlier, look at the STOs and the MACD. I would lose out on that 200 bucks if I applied my STOs to clear trading, because my STOs are near the top. My MACD is already above the zero line. So if I applied that rule to clear trades, I wouldn't be doing any clear trading. I would lose out on these really nice smooth moves. I would lose out. Okay? So you can't always apply it to clear trading. What you can apply to clear trading to help you, because you don't have the confirmation of the STOs, is the fact of matchy across the board, 2 time frames in sync, and most importantly, the HMA north of the border, south of the border rule. That's what you can apply to help you to compensate, I should say, for not having the STOs and MACD as a rule. That's your compromise. This is what you have. Position of the candle position in relation to the HMA north or south of the line based on your 3-minute chart. That is compensating for you not having the STOs in alignment for clear trades. And most importantly, that's what's giving you your 2 or more time frames matchy. Is that clear? So look, we just made another, $100 on that move, 110 bucks. Chasing the low of the day, you knew where it was going to, there was your benchmark, and there's a nice pivot for you to get out on, good timing to get out. And what are you following? The matchy rule, the HMAs, and that's what trend trading is all about. When you have majority of time frames in sync like this, that represents strong agreement. That represents lots of traders. You can look at other things like your 50 is about to cross your 200. Your 100 is looking like it's going to give you a tidal wave here. You can use indicators like the TW, the tidal wave. There's a nice tidal wave forming, telling you the market's going lower. Now, when this thing does finally tick up and this thing finally does turn, we're going to have a reversal, a new counter trend developing. Let's quickly do that, and we will end off there. So I can show you the difference between the two. Let's see that. See how much lower it's going? The MACD, now the MACD and STOs are starting to tick up. Now we're in sync, but this is still a counter trend. This is still a counter trend. This is your classic reversal trade. It starts with a gap and the new trend is starting to develop, but it's not always a guarantee because you're going into moving averages. This is the trend. Starts with the touching candle, enter as close to the 13 as possible, enter at the cross, You trade with the majority of the moving averages. Here you're trading into the moving averages. So there was your first attempt at a counter trend reversal, gap trade or reversal, and here comes the second attempt. Notice we had a runaway stow coming right back down. These are your basic stow rules that you should know. Let me speed it up. Now we're going to try, and here we go. Now the trend is developing in the new direction. See the stows here? There's the stows, there's the MACD. Another reversal opportunity. Note we just crossed the 50. And now we have the touching candle, and we have a clear trade opportunity running up towards that 200. Touching candle, very next bar, another clear trade. So we always break up price action into clear trade or gap trade or reversal trade. And over here with a clear trade, it must have 3 moving averages back in the direction and higher time frames in sync. Here you can see 5 minutes is closing the gap, therefore we're going higher. So you can start to look at the correlation there. 6 minutes closing the gap, so we're starting to go higher. The fact that it's in sync is what's giving you the probability factor. But at the end of the day, it has to be a clear trade or a gap trade or a reversal trade. Here's your clear trade, here's your reversal trade, here's your gap trade. It's one of those 3 strategies, and that's all you're trading, whether you're using HMAs or whatever you're using. That's all you're trading at the end of the day. And if you follow the rules for that timing, guys, you'll do a lot better. And make sure, as your homework for this week, send me your email me at Melanie Sun Trades, and I'll send you these 2 PDFs, which will give you the rules. It will redefine the rules for you. And also, as additional homework, this guys, because I know a lot of you haven't done it in a long time, and you need to revise so that it becomes automatic. Remember, I always talk about it must be automatic. You shouldn't have to think about these things. You should know, oh, 200, I'm looking for a bounce off the 200. I want you guys to go through section 5 in your self-paced course and read Putting It All Together, to help you look for good opportunities to do your classic gap trade, your reversal trade, and clear trade. Those are good timings to do these things. Like run to the R4, lower highs, double tops, good times to do gap trade, double tops, bounces off the 200, run to the 200, good times to do trend trades, these kinds of things. Do you have any rule for a trend trade, like if the price is below the 50, don't trade long? Yes, I do have a rule. I've discussed that many times in the past. Here, I do have a rule. I always tell people, and this is where terminology is going to be, verbiage and terminology is going to get you a little confused, because Barbara likes to call this the trend, because it is the trend that's developing. But in terms of strategies, the way they've been designed, it's really actually the counter trend. Okay, so this is the one area you're going to get confused with terminology. Okay, because she calls this the trend, but it's not actually the trend. This is the trend. The trend is all, the only thing that constitutes the trend is how many moving averages are back in the direction. So actually we're only in the trend once we cross that 50. It has to have 3 moving averages or more to constitute the trend. But this is the start of the new trend. So it's really the counter trend. So I always tell people, never ever enter after the cross here expecting it to go through the 50, especially if you see a trajectory like that on the 50. For that to happen, you must have very strong matchy-matchy. And you'll know that you're on the counter trend. You know how you know that you're on the counter trend and not trend? How do you know? This is your last question of the day. How do you know that you're on the counter trend and not the trend here? Who can tell me? Awesome, Jeff. Jeff said it was a great class for him. He absorbed a lot. How do you know who's giving? So a lot of you say Stowe's, MACD, MACDs, and moving averages, fighting moving averages, price below the 13, into SMA, only 2 moving averages. No, none of you have given me the right answer. Joe, you get a cookie. Jerry gets a cookie. All those who said check the higher time frame, you get a cookie. Because look here. Actually, let's get rid of the 3. It's too short term. Let's go to 15. What is the 15-minute chart telling you that we're doing? What are we doing? Gap trade. Kathy says, yeah, I got fat and cookies today. Gap trade. Gap trade is the counter trend. So I ask you, are you on the trend or are you on the counter trend? Because what do you expect that's going to happen after this? Well, very well. If the 50-minute hits the 13 moving average and we're going through the center line, we could come right back down. We could come right back down. Watch this. I'll take it to 500. We could come right back down. Yeah? The trend is developing, and that's the reason, like I said, you have up and down days, up and down price action in the market, because why? At the end of the day, if we take it to our 120-minute chart or our 240-minute chart, oops, okay, I'm doing 2 orders on one, didn't like that. At the end of the day, we're doing a counter trend. If we look at our 240-minute chart, see, it doesn't always cross smoothly. It goes up and down at those crosses. Why? Because we're gap trading. Look, the 240 hit the 13 moving average and bouncing off the 13. Now it's going to go back up again. Try again to try to cross here. Why? Because if you look at the 480 chart, the 480 chart is doing a gap trade. Got to come down, hit that support. Got to test that support. It's going to go back up and try to continue closing the gap. Could take all night to do that. But all you know is that if it's in a counter trend, you're going to be up and down. So look long and short. The most important thing is you follow the rules. You only trend when there's moving averages back in your direction, and you counter trend. So here you were getting at the gap trade part, and you would ride it through the cross. This is the best place to do reversals. Ride it through the cross and take fewer ticks, 3 to 6 ticks max. Don't go for 10 ticks. 3 to 6 max. When you're on a trend, you can go for 10 ticks. Yeah, you can go for 10 ticks or more, as I've demonstrated. So we have to end off. Hope you guys got a lot out of today. Go practice matchy across the board. Practice your counter trend trades, looking for your MACDs and STOs on the counter trends, and your gap trades. Thank you guys for listening, and I wish you the best. And remember, we're in the summer doldrums. August is a very bad month. Trade very cautiously. Rather wait till September if you can. The market will come back to battery, and you'll see better trends. If you must trade, try to keep them to 3 ticks and scalping opportunities. Thank you guys, and I'll see you later.
The organizer has ended the session, and this call will be disconnected. Goodbye.